Well, it looks like we are getting our first glimpse at how this pandemic is affecting our nation's banks. This morning, we heard from JPMorgan Chase. First quarter profit, they're tumbling 69% to its lowest level since 2013. JPM also setting aside $6.8 billion for credit losses. We also heard from Wells Fargo reporting first quarter earnings results that were well below analyst estimates. It, too, is setting aside a large chunk of money for credit losses. To talk about bank earnings now, I want to welcome David George, who joins us on the phone. He is Senior Research Analyst at Baird. David, good to have you on the show. Just first off, any surprises in the bank earnings that you saw this morning?
Well, first, good morning. Thanks for having me on. No, this was kind of a wild card in terms of what to expect, and in particular the size of the credit provisions, and given that the rapid nature and kind of fluidity of everything, the size of these provisions were fairly significant, but not particularly surprising, and we don't think the market will be particularly surprised either, and actually think that we'll get a decent bounce in these today based on these earnings.
David, how concerned are you about the dividend risk for Wells Fargo and JPMorgan? I think it was JPMorgan's CFO on the earnings call this morning, perhaps foreshadow some action on the dividend.
From our perspective, and I guess starting with JPMorgan, in our opinion, if provisions peak in Q1, and I'm of the opinion that the roughly $8 billion in losses that they took, or provisions that they took in the first quarter, is probably the peak for this downturn. We're not of the view that there's meaningful dividend risk at JPMorgan. Now, to the extent that the economic outlook deteriorates further from here, and there's a need for continued elevated provisions, really to the tune of kind of current levels that we saw in the first quarter, then I think there's a risk of a dividend. But again, this is JPMorgan still made 75 cents after taking $8 billion in provisions. That's normally the amount they would take in a full year, and they did that simply in one quarter. In the case of Wells, there's probably a little bit more dividend risk simply because their pre-credit, or what we would call pre-provision profitability, is somewhat inferior to JPMorgan. So there's a little more risk of dividend impact at Wells than JPM. But broadly, we don't see a ton of dividend risk at the moment.
David, talk to us a little bit more about all the money these two banks are setting aside, and I'm sure we'll hear more of the same from the other banks as they report. The money they're setting aside for credit losses. What are we to read into this? Are people already not being able to make those credit card payments and those mortgage payments?
Yeah, it's a good question. So unfortunately, and it's somewhat of a timing issue, in 2020, not to get too far into the weeds, but accounting supervisors have changed the way banks, particularly large banks, account for credit losses. So the provision is called CECL, or CECL, and what it basically stipulates is that banks have to estimate life of losses as soon as economic data changes or the outlook changes. So even though we've really only been in this pandemic for 3 to 4 weeks, that's usually not that long of a period of time to actually see deterioration in terms of payment history and non-performing loan movement. But what JPMorgan and Wells did is basically their estimate for life of losses based on the economic data today. So, for example, things like unemployment is probably the biggest driver, as well as kind of the go-forward GDP outlook. Those two factors would have the biggest determining factor for provisions this quarter. So it's a function of kind of real-time economic data rather than an indication of payment history and payment performance today.
David, what's your read on U.S. consumer spending? And I point to Wells Fargo, credit card spending down 1% in the quarter, debit card spending only up 5%. This was before the worst of the crisis. How do you think the second quarter is shaping up?
If you look at spend data, and obviously, like I said a moment ago, the first quarter really is two different periods of time. January 1st to kind of March 10th is when this really started in terms of economic activity. If I had to estimate, I think the economy spend is trending probably down 10 to down 15. So to the extent we stay in this kind of stay-at-home mantra, every month that goes by, I think we'll be in that 10 to 15% downward spend trajectory. Now, to the extent we see a rebound or kind of a slow reopening of the economy, then I would think that those numbers start to get better.
David, before this pandemic, which bank was best positioned to head into a crisis such as this and to come out of it fairly unscathed, can we say?
From our perspective, the banks that came into this with the best ability to earn through it are those that have what we would call either the strongest balance sheets or the highest pre-provision or pre-credit expense profitability. So some of those companies would be JPMorgan, PNC, U.S. Bancorp, Bank of America. So those would be kind of 3 or 4 companies that come to mind in terms of their positioning to kind of weather this downturn.
All right. We want to thank you very much, David George, Senior Research Analyst at Baird. Thanks for your insights this morning.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.